Greetings from your team here at Heritage, and welcome to our call. I'll take a few minutes here and just talk about this most recent quarter, maybe kind of where we are year to date, our perspective on that, and then just some thoughts going forward. On the last call, I talked about, I felt like there were going to be two phases to this the COVID recovery. And the first phase was Zoom, online purchases, people being quarantined at home. But the second phase is I think what we've seen this summer, and that's people getting out and doing things. We've seen air travel get back almost to pre-COVID levels. Hotel occupancies went way up, and just travel this summer was phenomenal. And it was really exciting to see people get back out and do things again. And we'll talk a little bit more about that here in just a second. But one of the things that has become so apparent in this is just this wealth effect that has really kicked in at the valuations of real estate and equity markets and people sitting on additional cash. But Americans' household net worth is approaching $150 trillion. And that's T as in trillion. It's never been this high before. And between money market accounts and just bank savings accounts, Americans have almost $15 trillion in cash. And they are spending it like crazy. It's creating bottlenecks at our ports. It's creating worker shortages. It's creating some inflation, and we'll talk about that here in just a minute too. The other big thing I think that's come up recently is just this Delta variant, so a new variation of COVID. And not that anything positive can come from that, but I think there may be something economically that has slowed this recovery a bit, which I think has the potential to extend our recovery well into next year, as it has slowed down some of this travel. So people are not spending probably as much as they would have. So if anything good can come from Delta, it's the fact that I think this will make this a longer lived recovery. But this summer was absolutely amazing, just watching what's happening. If you go into stores right now, it's amazing. Store shelves are empty, and companies are working diligently to get supply chains back up and running, shipping. Last week, there was a note that there were 73 ships anchored off the coast of the port of Los Angeles, and they just can't unload them fast enough. And even if they get them unloaded, there's not enough truck drivers to get the products trucked out across the country. But the great thing about businesses and in situations like this is there's an incentive for businesses to hire new workers, to get caught up and to get the products to people. And I think as we get out next 6, 12, 18 months, I think we'll see this begin to wane, as demand begins to slow and companies get caught back up with this. But as we look at equity markets, they're doing well as we would expect because businesses are doing so well in the midst of all of this. If they had more product, they could sell more product. It's been interesting to hear of some of the shortages, this whole semiconductor shortage. They can't manufacture enough vehicles and things. And a lot of that goes back to last February, March, when we shut down the economy. Businesses stopped manufacturing cars. They stopped manufacturing all these products and had no idea that we would just flip the switch and turn things on again and there would be this demand like there has been. So they will eventually catch up on things. And I think consumers just need to be patient and maybe invest some of this cash instead of just sitting on all this cash. But markets have done very, very well this year. This third quarter, we did see more volatility than we have seen, really over the last 12 months. The markets have gone up almost just straight up for 18 months. We had a little bit of volatility in the fall of last year, and we're seeing a little more here recently. Some of that has to do with the debt ceiling conversations in Washington. We've got new taxes being discussed in Washington. Probably the biggest thing is this Federal Reserve tapering. Back in February, March of last year, the Federal Reserve Bank of the United States began purchasing $120 billion a month of U.S. Treasuries and mortgage-backed securities. Twofold, to keep interest rates low, but also basically to create a demand for those bonds. Well, they're going to have to begin tapering those purchases, and that may happen here as soon as November. And the last time we went through something like this was in 2012, 2013, after the financial crisis, and it created more volatility in the market. It's just investors were concerned about that. But we have to taper this back. We have to stop buying our own debt as a country. We've got to stop that. So I think that's going to be some nervous. You're going to hear a lot of conversation around that. The other thing really that's been making markets nervous is China. Xi Jinping, the president of China, has really begun to clamp down on some of the largest publicly traded corporations in China. And we're really beginning to see many of the freedoms that China has experienced over these last 20 years disappearing. So that will be something to watch. And it's important because they are now the second largest economy in the world. But so talking about markets and consumers, businesses, American businesses have essentially refinanced all their debt just like Americans have. They've issued new bonds. They are flush with cash and are announcing record capital expenditures. So that's investing in their business for future growth. So that is a very, very positive thing happening there. They're also increasing dividends. They're buying stock back, which is a great thing too, because they're passing profits back to shareholders. So many positive things happening there with businesses, along with we're seeing more and more reshoring, which is companies bringing manufacturing back to the United States. If we remember back 2 years ago, the beginning of COVID-19, it started in China, and it started with a disruption in supply chains. We are going to see a divestiture of manufacturing from exclusively in China to other parts of the world. And Mexico will probably be a huge benefactor of that. So it'll be very interesting to watch all of that. But so I think as we look forward, I think this expansion will continue well into next year as there is continued pent-up demand. And as we begin to open up Europe and other places of the world for travel, I think you're going to see travel continue in a very big way for the next several years. So here at the Heritage, some things that we're going to do is we're going to continue to do Zoom meetings going forward if that's a convenience for you. I think today we now have equipment in our office and whatnot to do all of that. So we can meet in person. You may notice a different color. We've got new paint, new carpet here at the suite too. So we do welcome you here into the offices again at Heritage. We are having the Christmas dinner this year. So if you are comfortable coming out and gathering with people, I believe it's December the 2nd, Thursday evening at Maggiano's again. So welcome to that. A number of you have asked about Robert. He is home recovering from back surgery, but he's beginning to work some part-time. So last quarter, we shot this video from home because I was mending from some minor knee surgery. So I'm back. So the team is coming back. And then I do want to mention that Bree is going to be leaving us here this month. She is taking a new position with a firm that matches up the influencers on social media with different brands and stuff. So as I mentioned to her, I think it's the perfect job for her, a perfect millennial job, but we will miss her and her energy here. So please share any thoughts, comments you have with me, and we look forward to seeing you here this fall. Take care.